All right, everyone. Welcome to the overnight session, episode 6, I believe. So this one, I just wanted to make because my previous one, I did say that I was going to organize my earnings list on TradingView and go over a bunch of stocks with you guys. So I'm going to do that. And then I got like 2 other YouTube short clips that I want to react to, just to kind of give some brief thoughts on. So let's get right into it. Oh, and then we also have a question. I guess we'll start with the question because we might not actually know. We're not going to cover the stock that's in the question, but we'll just go ahead and get started. So today I am still sitting at 242 because it is the weekend and I only have a small crypto position. But the stocks that we're going to go over today for earnings this month, we got Netflix, KMI, COF, Invesco. We got VFC, which is Vans. We got Meta, Microsoft, Levi's, Amazon, Apple. We got Eastman, which is more like a chemical stock. We got NASDAQ, ExxonMobil. We got American Express, SOFI, Royal Caribbean, Visa, and Chevron. So we're going to be getting into a whole lot today. But to start off, we're actually going to react to a funny video. Because when I saw this on X, I just had to share this with y'all. And it's this one right here. So apparently there's a guy that built a computer that it basically makes video games very realistic. And I don't know why anybody would do this, but just wait till y'all see. Man is dodging bullets in real life. Can you imagine? Dude. It's flooding in real life. Oh man. Can you imagine playing Call of Duty like this? Like with how fast paced, let me pause this. With how fast paced Call of Duty is, like could you imagine playing that with this, or Battlefield? Just look at this. Oh goodness. All right, well, I'm not sure if that's exactly a W, but you know, if you like this video, I guess you could go check out this guy's X account. That's where I got it from. But yeah, could you imagine, man? Anyways, so we're gonna get into Netflix first. So this is the weekly. Let's go to the monthly. So it did break this 21 moving average on the monthly. Now keep in mind, this could just be like a wipe of anybody that was early to buying the dip. Right, so anybody that saw this as support started buying at 94. This could just be a brief little wipe before it goes right back up, right? To wipe out the early longs. And basically, for anybody that doesn't know what that means, what I mean by early longs is people that bought the dip early. So let's say you thought this was support right here at 95, you bought it at 95, and now you're down at 88. So maybe, you know, some people will, you know, just change their mind, or they just don't feel good about their investment anymore, so they just start selling, whatever, or they get margin called. But anyways, this could be a break of that support, or it could just be a little wipe of the bulls. But there is this extremely important support zone that it could come back down to, which is around 70. So that is kind of scary. And we got this moving average, which is the 50, I believe. So it could slowly start to creep up and create support around 70. And that would be a what percentage drop from here? So back to 70 would be a 20% drop. So definitely substantial. Let's go to the weekly. And I honestly don't like Netflix like as a streaming site. But, you know, when I take a look at the fundamentals and look at it on the charts, it's definitely something that I still need to pay attention to, right? I got to put aside my personal, I guess, feelings and opinions on Netflix and just look at it strictly from a numbers point of view. So on the weekly chart, it is very oversold, but keep in mind it was also oversold back in March of 22 before this huge wipe down. And then this consolidation period here before this nice wave up. So it could do that again, right? A 20% drop down to, you know, the 70, 60 area before it starts to creep back up. So keep that in mind. On the daily, of course, very oversold. Lots of false signals here. So Honestly, earnings, it could do it could be anything. Let's see. Like I said, it could be a 20% drop after earnings, or it could be a 20% pop after earnings to retest this old resistance, right? This old support, which is now resistance. But if you take a look at it from strictly numbers point of view, we got free cash flow per share at around $20. Keep in mind, this is an $88 stock, right? So that's, even because I can't do the math off the top of my head very quickly, if this stock goes to $100 per share, that's still a 20% free cash flow yield. So keep that in mind. That is phenomenal. And even if this is like pre-split numbers or whatever, and we divide this by what, 4, whatever, $5 on 88, that's still a very high free cash flow yield, right? But free cash flow per share, last 5-year average around $5 to $10. So they are growing it, it seems like. 5-year revenue trend, 13%. Anybody that has a Netflix subscription knows that they've been hiking and growing that revenue like crazy. We got tangible book value, which is, Grok is having a hard time finding it, but around $6 for book value. Return on capital is around 20%, very good. It's a solid number. Short interest is very low. So, volatility could be very low, or people are just, they're not seeing a lot more downside, if that makes any sense. They don't want to bet on it. And share count is going down, the trend is. So they are buying back stock, which is good. So this is definitely something that I want to keep on my watch list, keep on my earnings list, and I could possibly play it, play earnings on Netflix. I just don't know if I want it in my main Robinhood brokerage account, because I am trying to build out a position in Disney. But definitely after looking at the numbers, I can't just overlook Netflix. It's also got this big gap right here all the way back at 120. And keep in mind, even all the way at 120, that free cash flow yield is still high. So what percentage would that be? Let's check it out. So it's about 37%, 37% pop from here. So it is substantial, just to get back up to the 200-day moving average. That's 113, right? So definitely one I want to keep on my watch list. So the second one's going to be KMI. Let's get this going while we're looking at the charts. All right, let's take a look at KMI on the monthly first. So this huge period of consolidation since January of 2016 all the way to about 2025-ish, or the end of 2024. So lots of consolidation here. We got this nice recent period of consolidation, basically for a year. Yeah, so basically for about a year it's been consolidating, just to get back up to this high that we made recently. That's a 13% pop from here. A nice dividend of 4%. So it is one I could also consider. Look at this. Beautiful. Moving averages are converging. Nice consolidation, right? So it's looking for a big move. We just got to see which direction it's going to go. So nice uptrend here on this indicator that I have. So definitely one that I want to keep on my watch list. Let's take a look at the fundamentals. Free cash per share 122. So 122 on, so that's about, what is that, 122? I can't do math right now. That's about what, 5% or something like that. Let me just 1.22, divide that by, let's just say 28. Yeah, so that's about 4.3% free cash flow yield, basically their dividend, right? So I was close, guys. Come on. So definitely one I want to keep on my watch list. So basically, as I suspected, their free cash flow is their dividend, right? So it's very close. Free cash flow per share average is about 150, so it's not bad. Kind of stagnant though. But are they at least buying back stocks? No, slightly up. So, not really something that I'd like to see, especially on a flat company, right? Just a stable, boring company. I kind of want to see the share count go down at least, so I'm owning more of the company. But it's still something to keep an eye on for me. Take a look at COF while we load this up. So on the monthly, beautiful uptrend here recently. A little brief correction here in the short term, more recently, because of the credit card cap, of course. And I talked about the credit card cap in my last video, and I'll talk about it more in this video. But I think this credit card cap is a nothing burger, right? It's going to be nothing. So if these credit card companies start going down even more, definitely an opportunity. Yeah, so it's already starting to fill that gap. So anybody that bought this gap, you're already up. Yeah, and they got earnings on the 22nd. Yeah, 22nd, in 4 days, they got earnings. Let's look at the short term. So it wasn't exactly oversold, but it still came down quite a bit. $32 free cash flow per share. That is crazy. So that's over 10%. That is over a 10% free cash flow yield. That is crazy. Okay, so they have been diluting probably because they bought Discover recently. So that's going to mess up the numbers a little bit. Tangible book value per share, $100. That's pretty good. 5-year revenue trend is up. We'll just say 5%. Dividend is definitely affordable. Yeah, so I'm going to keep an eye on Capital One. I was never really interested in Capital One stock until they bought Discover. I used to be a shareholder of Discover, so that is what brought my interest into this company. Let's take a look at IVZ. So it looks like they broke this resistance finally of 24 on the 200 monthly moving average, which is huge for this company. Beautiful uptrend above all the moving averages on the weekly. Yeah, beautiful uptrend. Almost 3% dividend yield. Let's see, free cash flow per share, $250. So it's a little bit below 10% free cash flow yield, but still not bad. So it's slightly diluting. So it's more one of those boring stocks, I guess. VFC. VFC on the monthly. So it looks like it wants to enter this period of consolidation. Yeah, so it's about to test that 200 weekly, and if it breaks that 200 weekly, that's going to be huge for VFC, right? It could tag 45 as the level that I already had. Yeah, so it's already above all the moving average, or somewhat. It's above the 200 daily at least. Let's take a look at VFC free cash per share, 71 cents. So it's about 5%. 5% free cash flow yield. That's not bad. They are diluting shares though. Yeah, revenue's kind of struggling there, similar to other clothing stocks. Yeah, so, but short interest is almost 7%. Meta. I don't think I saw the short interest of Invesco, but I don't think it matters. So Meta on the monthly, yes, a huge support right here on the 21 monthly, right? Any of these like monthly moving averages, tend to be a very strong support, right? As you can see, the 9 monthly has acted as very important support for a long time. And then the 21 acted as support back here in April. And then here, we don't know yet. We'll see, but possibly will be act as support again. Or it could come all the way back down to 415, 420. Let's take a look at the weekly. So, yeah, basically consolidating. Moving averages are converging. So it is below, but it could. See how much is that if it fills the gap. 20%. So it'd be a 20% pop. $21. So that's slightly below 5%. Short interest is low. They are buying back stock. Dividend is very affordable, but it's also low. So yeah, another one of those. I'll keep it on the list. I mean, it's big tech after all. We'll go with MSFT. Oh man, that's not looking too good. You know, it could possibly come back down. How much would that be? If it fills this gap down here, it's a 13%. 13% drop. And how much is that from all-time highs? Well, somewhat all-time highs. It would almost be a 30% drop, which is crazy. So it's coming back down to retest this important zone here, support zone. I might possibly buy some Microsoft just as like a steady Eddie type of stock. $10 free cash flow per share. So that's it's like what 2.5-3% free cash flow yield, something like that. Dividends affordable. Tangible book value. So they're buying back stock. Short interest is very low, under 1%. Wow. So if short interest starts to pick up even just a little bit, that could possibly bring this down even more. So it is something to keep in mind for the Microsoft buyers. But it could see a pop still. It could definitely still see a pop on earnings. But we'll see if I end up betting on it or not. Oh my goodness. Look at this beautiful chart. This is something I like to see. So 11% pop if it fills the gap. Let's go ahead and load up Grok. Monthly, beautiful. Look at this. Monthly averages were converging. It IPO'd in 2019. It hasn't done anything. And now the moving averages are converging, possibly going to break. If it breaks all-time highs, how much would that be? Yes, that'd be over 40%. 40% for Levi's. Dividend is 2.5. That's not bad, but it's probably not going to be a dividend grower. Let's just be honest. Yeah, I will keep this. Yeah. So I possibly will make a play on this. Let's see what these numbers are looking like. $1, 5% free cash flow yield. Dividends affordable, basically half of their free cash flow. Short interest is 2%. Slightly down because they've been buying back a little bit. Definitely, I will keep Levi's. So Levi's. Let's put that in the invest. And then what else did I want? What else was I gonna make a play on? VFC maybe. Netflix was another one. I know this is like a whole bunch of stuff that's being thrown on y'all's screen. Oh, Ferrari stock is also not bad. I might take a look at that one. Possibly. Let's look at Ferrari, actually. Slightly off track, but oh, no pun intended, off track. Let's see. Ferrari. And then we'll go back to earnings. So nice gap here. Let's mark that. Mark that bad boy. Zoom out a little bit. Oh, look at that. Beautiful support right here. All the way back down to support. Definitely could see myself 870. So free cash flow yield is pretty low. Buying back stock though. Return on capital is amazing. Yeah. Let's take a look at the charts though. So it looks like it's breaking support there on the 200 weekly, but you know, it's Ferrari, you know what I mean? Let's take a look at this. 37% upside right there. Let's put this bad boy up here. Put this hot rod up here. I definitely would like to see that. Yeah, definitely could possibly KMI. Let's put that, throw that in a trading one. Pinterest maybe, but definitely would like some Ferrari. Okay, Amazon was next. Amazon, nice consolidation here, basically since 2025. It doesn't look overbought on the higher time frames, which is not bad. What if it breaks all-time highs? Let's take a look at that. So, I mean, it's a little baby pump, you know, 9%. That's not bad. Chart looks fine. You know, it's consolidating. It looks like it wants to come back up. Yeah, I mean, it's a whatever. It's Amazon, you know, at the end of the day. 350, basically 1.5% free cash flow yields. It's nothing crazy. Slightly up on the dilution, just a little bit. So, it's Amazon, you know, it's Amazon. Let's take a look at Apple. I think Apple's been sold off like crazy if we look at the daily, right? So lots of selling pressure on Apple on the daily. And by the way, guys, if you like this and you would like me to do this live, you know, I really want to do live streams, especially on months like this month and next month where we have tons of earnings. We got big banks, we got big tech, basically a whole bunch of companies like, you know, American Express, ExxonMobil, a lot of these companies, Netflix, they're reporting. I would love to do live streams and live trading where I place like big bets on whether I think the stock's going to go up or down, right? And I'd really like to do that, but you know, I only have like 5 of you guys watching at a time, which is, you know, it's not, numbers aren't everything. You know, I just do this because I like doing it, but at the end of the day, you know, it has to, if I'm going to do a live stream, it has to justify, the numbers have to justify it, right? So it broke out, it's coming back down to retest. How much off is it from all-time highs? Curious. So it's correction territory. Correction territory, it could come back down to 230. So if it comes back down to 230, it's just continuously consolidating, right? So it's not the end of the world, but it just means it's cooling off. I could see myself getting into Apple, especially because I don't own any Apple. I might in like a separate brokerage account that I just have passively, right? That I have running in the background, you know, maybe some ETFs here and there. Definitely, you know, a big boy like Apple's going to be in some ETFs, so I probably have a little bit, but I don't have a whole lot of like actual equity in Apple, right? So definitely one I could see myself getting into, even if it goes down on earnings. So, but let's take a look. Free cash flow per share, definitely low on the free cash flow per share. It's below 5% yield. They can afford their dividend though, so that's good. Still growing 9%. That's not bad. I was expecting negative, to be honest, for Apple. Tangible book value is low, very low. Price to sales, return on capital is very high for Apple, obviously 40%. That's crazy. Short interest is very low, right? It's another one of these big techs that people don't like to short because there's so much buying pressure. And if this ticks up even just a little bit, we could probably see some selling pressure. And they obviously continue to buy back stock because they just have the cash to do it. So I could see myself getting into Apple. Let's put that big boy up here. We'll put it in trading for now. Yeah. I want to trade my way into Apple. Apple's one of those big boys that has made a lot of winners already. I like to be a part of companies that are in the process of making a winner. You know what I mean? So put that there for now. I wonder, Lemonade though. What's their earnings? Okay, so their earnings is far away. But let's look at, oh man, look at that. Look at this pinch right here. Eastman. Let's take a look at the monthly. It did break 200 monthly. It's come back up to retest. So it's resistance right here. Something to keep in mind. It is almost a 5% dividend yield. However, so downtrend, but it's been consolidating. So not really something I'd like to see. But it did come back up to fill this gap here. And it's coming back to retest that 200 daily. If it breaks it, it could go to 80 very quickly. Take a look at the fundamentals. For basically $3 free cash flow. So it's, we'll just say 5% free cash flow yield. Basically all of their cash flow is dividends. It's a slow grower. So you guys starting to see how I use AI to quickly analyze companies instead of, digging through books of just financial statements and just all of the, like, analyst calls, whatever, the earnings calls. There's nothing wrong with that. Definitely pay attention to that because it's, it's important to keep track of that. But I like to quickly breeze through fundamentals and technicals, right? So they are buying back stocks. So that's something. Return on capital is low. So it's one of those slow moving companies, It's a chemical company after all. But if it breaks 70, it's going to go to 80. Right? I mean, it might cool off a little bit when it breaks 70, but it'll go to 80 if it does. And I don't think I have a big position in it. I don't think I have any chemical stocks, to be honest. So another one I will keep in mind. Let's go to NASDAQ, NDAQ. The NASDAQ. So beautiful chart here. Nice little uptrend. It's nothing too exciting, but if you were a shareholder in this company, you definitely won, right? So it's been one of those buy and hold stocks, even during this period right here from 2021 to 2023. If you just kept buying the dip, you ended up being a winner anyway. So it's one of those types of stocks, but that nice round 100 number. Dividends 1%. It did break. It consolidated a little bit before that breakout, so that's good to see. Consolidated a little bit, and then that 21 daily helped push it up. So you see how that 200 daily acted as support here for that wave up. A beautiful chart, beautiful. It's basically a 3% free cash flow yield. A third of their cash flow is dividend. Decent grower, right? It's one of those big boys. 20%. They've been buying back stock. 1% share short. So it's decent, you know, it's decent. It's one of those stocks like on pullbacks, you just kind of buy a little bit. That's how it's been basically since it IPO'd. But let's go to Exxon. So NASDAQ wasn't too exciting, but it's not supposed to be, right? It's supposed to be one of those buy and hold type of stocks. That's how it's been. So Exxon, huge consolidation here for a few years now, and it just recently broke. Oh, let's see. Yeah, look at that. Beautiful. Look at this beautiful consolidation. That 200 weekly creeping up to help push it up. Yeah, lots of consolidation, and now it's breaking. Right, we had a lot of big boy buys here. Big boys were buying the dips for Exxon Mobil. Let's take a look. Free cash flow is 8, so definitely a decent free cash flow yield. Dividend, they pay half of their cash flow as dividend. Tangible book value is about half of the stock price. Yeah, I mean, what is their revenue growth? 11%. Yeah, I mean, people hate buying it because it's oil, but at the end of the day, you can't argue with the numbers and you can't argue with the chart, you know? Can't hate on it. I mean, American Express has been a company that I've already analyzed multiple times on the charts, but I guess we'll just go ahead and do it anyway. I've already taken a look at it multiple times, so let's go to the 3 months just to make it interesting. Yeah, beautiful. Beautiful uptrend. I gotta get rid of all these. I gotta get rid of all this though. Clean this up a little bit for y'all. Clean that bad boy up a little bit. Yep. So monthly, a little signal here that might not be good, but at the end of the day, it's American Express. So it did break out. Looks like it wants to come back down and retest. Yeah, it's just consolidating right now. It's just kind of flat, huge free cash flow yield on American Express, similar to Capital One, buying back stock, decent revenue growth, dividends very affordable. So just another one of those companies, you know. SOFI, big boy buys right here, looks like on the daily. Looks like it broke out. Now it's just retesting to consolidate. Boot up SOFI. Moving averages are crossing down, which is not something you want to see, but could also be a fake out, right? Big boy buy right here though. Somebody bought the dip. It could still definitely come back down to 22 though. So I don't know if I want to buy more of SOFI, but these are some old labels too from a long time ago when I was buying SOFI, like towards around here. Yeah, I'm pretty sure I bought SOFI a long time ago around here. Like $7.50 was my average price. And I labeled the supports. This was when SoftBank sold. This is the CEO buys from Noto. So I like to label it sometimes. Oh, wait. We did not look at the fundamentals for SoFi. Negative free cash flow. Okay. Revenue is tremendous, though. Revenue is crazy. Yeah. Short interest is high, so volatility will be high. So a good stock to be trading if that's your thing. Return on capital, or possibly a good stock to trade. You know, I don't give financial advice. Return on capital, they are diluting though. That's one thing I don't like. about SOFI. They are diluting. Royal Caribbean RCL. Let's take a look at the 3-month. Looks like it's coming back down to retest that support. Yeah, so it came, that acted as support. Looks like it's just consolidating now. Yeah, so the moving averages are crossing over. It's just very volatile while it's trying to pick a side, right? It's picking which direction it wants to go. Free cash flow per share 7, so it's a low yield, but dividend is affordable. 10% average on the growth rate. Short interest is about 5%. They are buying back stock. Yeah, just another one of those. Just another one of those companies. Let's do Visa. Visa. So if I do end up trading Netflix, it will be after the close. So possibly we'll be recording. Possibly. But it's the, all right. So Visa looks like it's consolidating. See those moving averages, and it looks kind of scary here in the short term. Okay, 9 3-month, 21 monthly support. Okay, so the moving averages. I could see myself buying some Visa. I don't think I have any Visa, to be honest. Looks like it's starting to creep into oversold. 11. Yeah, so it's a low free cash flow yield, but it's not bad. They can afford their dividend. Still growing revenue, even though they're a big boy. Buying back stock, so just another one of those companies, you know. They just buy and hold. CBX Chevron. Let's go to 3-month on this bad boy. So you see this huge consolidation. So Chevron, I'm surprised Exxon has been in a breakout. Yeah, see, Exxon is breaking out while Chevron has not. But that's kind of weird because I heard online. So don't take my word for it. This is online, right? But I heard that Chevron is actually the company that would benefit the most from Venezuelan oil, but it's not breaking out. So what would that be? 15% pump on a 4% dividend yield. So you see that? It's very similar to Exxon. Very similar. And it could hit, definitely tax. Definitely, I will consider Chevron. 200 weekly, acting as consolidation zone, and it could possibly be support to pump it to 190. Yeah, it's above the 200. It's been very volatile with the recent, world events, of course. But you see how it came back down, retest, very volatile, and it came right back out, and it was like consolidating right here. Made like this little wedge, right? So it's breaking out and it's consolidating, waiting for that next move. So definitely. I could see myself. Okay, I already have it in trading. Okay. Let's bring that somewhere up here. Yeah. Definitely going to consider that. Almost $8 free cash flow, so 5%. 5%, basically all their cash flows dividend. Almost that book value. Not tangible though. Buying back stock. Okay. So definitely want to keep an eye on. I like this pattern right here, this consolidation, and I like how it hasn't broke all-time highs yet. So definitely I will keep that one in mind. But yeah, so that was the earnings for this month. Let me know if I missed any in the comments, and then I'll go over in the next video. But we're going to react to a couple videos. So this is from More Perfect Union. I think they're a little bit more left-leaning. I don't really watch a lot of political news. I watch business news and sometimes political news will sometimes go into that business news that I like watching. So like CNBC, Bloomberg, Yahoo Finance, etc. Sometimes politics obviously will creep into it, but yeah, I mean, this is more perfect union, slightly left leaning, a little bit more, but we're just going to react to it.
So Congress is finally voting to ban themselves from trading stocks, but there's a massive catch that makes this whole thing feel almost meaningless. If you want to understand why, you just have to take a look at this one chart of the stock trade volume of Senator John Hickenlooper. Over 3 years, he made just over 50 trades, which is really not that much, but he's worth over $30 million. You see, the new law is called the Stop Insider Trading Act, and on paper, it looks good. It stops members of Congress and their spouses from buying new individual stocks. And if you can't buy new stocks, you can't insider trade, right? Well, according to the reporters over at Sludge, there's a pretty serious loophole here. You see, this law doesn't force members of Congress to sell the individual stocks that they already own, and it doesn't put their assets in a blind trust. It kind of just freezes their portfolios in place. Some prominent Democrats have pointed out that this law mostly just protects the wealthiest members of Congress without really reforming the problem. But what do they mean by that? Well, that gets us back to Senator Hickenlooper. He doesn't trade much, but he holds a ton of stock. He walked into Congress with an already pretty robust stock portfolio, many tech stocks. But Hickenlooper sits on the subcommittee for consumer protection, technology, and data privacy. He's presided over hearings on data security standards, consumer protections, and risks of new technology. And while holding these stocks, he's not exactly been a critic of big tech. He failed to sign on to multiple antitrust bills that his colleagues supported. So it's no surprise then that Google, Apple, and Microsoft are among his top donors, because when these companies do well, he does well. How could he ignore that? Holding these stocks at all is a conflict of interest in and of itself, and Hickenlooper isn't remotely alone here. South Carolina House Rep Ralph Norman sits on the Financial Services Committee while holding over $1 million in shares of American banks. Texas Rep Craig Goldman, who sits on an energy subcommittee, holds up to $5.5 million in oil and gas companies. Tennessee Senator Bill Hagerty is chair of a subcommittee on financial services, but holds stock in major financial companies like Pinnacle Bank, Ares Capital, and bought stock in JP Morgan Chase and Blackstone since joining the Senate. So this bill doesn't really reform the system, it just locks in this current level of corruption. Real reforms like the Restore Trust in Congress Act would force members of Congress to actually sell their stocks or at least put them in a blind trust, which is really the only way to ensure that our representatives stop caring about share prices and start caring about us. The current bill fails to do that. It's not about stopping insider trading, it's about grandfathering it in and taking credit for fixing the problem without actually solving it.
So the last thing he said there, grandfathering them in, yeah, it does kind of do that, right? So it is kind of true, but at the same time, I'm going to explain why you don't want to live in a country where politicians can't own stocks. And the reason for that is if you have a disconnect of business and politics, right? Businesses and senators are only going to act in their own interest, whether you like it or not, right? What they might seem like they care, but that's only because they want your votes, right? They might seem like they're supporting this company, but it's only because they want that stock price to go up because they most likely own some shares, right? So you don't want to live in a country where it's just completely disconnected, because then that incentive will just shift somewhere else. For example, if they're not making the money in the market, they're going to want that money up front from the government. So that means more taxes, more government revenue, so that they can get their big salaries, right? Big payouts from government, because business won't be there to do that for them, right? And they won't care if businesses are doing good, businesses are thriving, if they're creating more jobs or not, because they don't own stocks in these companies, right? So they just won't care. And the reason why even though it seems corrupt, I kind of want politicians to be able to buy stocks, because we have the internet. I'm able to see it, right? If I see a bunch of senators buying stock in, let's say, Chevron, don't you think I'm going to be interested at least a little bit in owning some Chevron? You know what I mean? So, or if a whole bunch of them start buying JP Morgan or American Express on this recent correction, or whatever you want to call it, this recent cool down because of the 10% cap, and they start buying American Express, Chase, or Capital One, etc., don't you think I'm going to pay attention to that? Right? So I'm all for senators and politicians buying stock as long as it's transparent, right? As long as we're able to see accurate information, whether it's through X or YouTube, TikTok, social media, as long as we're able to see it, and have the option to follow along, have the freedom to follow along, what's the problem, right? And if you own these stocks and politicians also own your stock, don't you think that could possibly make you some more money? You see what I'm saying? So a lot of people think that banning stock ownership or stock trading within Congress is going to like solve all their problems, but in reality, it's just going to transfer corruption from business to the state, and that's not really something that you want, right? Because they're not. Do you actually think that if senators are forced to sell all their stocks, they're just going to magically start caring about you? Like, let's be honest, right? Let's put on our thinking caps a little bit, right? Let's put on our market caps. Do you actually think if politicians are forced to sell all their stocks, they will overnight start caring about you? Answer is no. I guarantee you what's going to happen is overnight, if that happens, immediately they're going to start thinking, how can I make the same amount of money that I was in business at the government level? What is that going to mean? Well, maybe they do some government programs here and there to get votes, but most of that revenue will be through their salaries, right? Their bonuses, their overtime, whatever, their government benefits, right? So that money's just going to shift. So, it's good to be hopeful, right? With stuff like this, like, oh, if this new bill passes, our lives are just going to change. It's good to be hopeful, but I'm just trying to keep it real with you guys, right? So, and I'm trying to explain to you why it's better to have it at the business level, because at least we're able to see those trades and copy them, right? If a bunch of senators start buying Chevron, I have the option to follow them in that trade, right? But if they decide, hey, you know what, we're not going to own stocks anymore, we're just going to get a bigger salary at the government level, how am I supposed to benefit from that? Right? Unless, I start working for the federal government. How am I going to benefit from that? I'm not, right? I'm just going to end up paying more taxes. So, it's just my 2 cents in this topic, right? But
Wall Street is losing its mind over Trump's latest move to cap credit card interest rates. But the truth is more complicated. This graph shows the rising interest rate margin of the big banks. Think of credit card interest rates as having two parts. There's the base rate, which is mostly set by the government, and then there's the margin rate that's set by the credit card company on top of the base. The margin rate is their profit, and because banks have kept it so high, credit card users have had to hand over millions of dollars they otherwise could have saved or spent on things they actually need. Especially in the last 5 to 6 years, the banks have been experimenting with jacking up that rate over time, gouging consumers. But it wasn't always this way. Historically, credit card rates this high were illegal in many states. But a few things happened. First, the US allowed banks to set interest rates based on the law of whatever state they were based in. So banks, predictably, fled to low regulation states so they could charge whatever they wanted. Second, the banking industry consolidated. The whole sector is dominated by just a handful of major banks now, so they don't have to compete for your business anymore. Which is why you'll notice when you're shopping for a credit card that they no longer compete on rates, they compete on benefits. Miles, lounge access, cash back, all in place to distract you from what you're actually being charged. So with no meaningful competition or regulation, this lets banks jack up average credit card interest rates to between 21 and 24%. Just 10 years ago, it was closer to 12%. So a 10% cap on interest rates sounds like a nice win, right? Well, not really. Trump is only proposing this rate for 1 year as a temporary relief for Americans. But after 1 year, the banks can go right back to their predatory interest rate model. And worse, this one-year relief is likely to attract more people to credit cards, where they will accrue debt and then get
Exactly what I
locked
said in
into
my
those
last
interest
video.
rates snap back after 1 year. A real policy solution here would cap how much extra a bank can tack on, limiting the margin rate in this chart, stopping banks from gouging consumers while making sure that credit is still available. Nobody is exactly proposing that yet, but Senators Bernie Sanders and Josh Hawley have proposed the next best thing, a permanent 10% cap on credit card interest rates. But by taking their solution
Do
and
not do
limiting
that.
it to just 1 year, Trump isn't solving the problem, he's just neutering their bill, and even turning it into kind of a trap. And unfortunately, he's leaving the ability for the big banks to price gouge Americans in place. What we need right now isn't for the president to put debt on sale for a limited time. We need a permanent end to big bank loan sharking.
No. Look, credit cards are very useful. Okay, they're a tool just like anything else, right? If the way or one of the ways you should be using credit cards, for example, the Robinhood credit card, right? That's 3% on everything. The way that you should be using that is you make all your purchases, get 3% cash back, you redeem it into your Roth IRA for that full 3% amount, and then you also get that 3% IRA bonus on top of that, right? And you're basically funding your own retirement without actually using your own money, if that makes sense. You're not supposed to carry a balance and pay Robinhood that crazy, whatever it is, 27% interest rate. That's not what it's for, right? You're not supposed to carry debt on a credit card, right? But people do, and then they end up paying the price, and now they got to refinance, right? So it's only a trap if you're one of these individuals that say, screw it, I don't care if I pay off my monthly bill or whatever, I'm just going to carry a balance. Okay, you could see it as a trap, but is it really, right? And I think this is a good compromise from the president, right? I know a lot of Democrats for a long time have been pushing this 10% cap, and Trump, he's kind of like compromising by making it like a promo period of 12 months. And when it comes to what this means for credit card companies, honestly, it's a nothing burger. Anybody that's been in the credit card space for a long time now, you'll know that credit card companies, since as long as I've been alive, have been doing promo periods, right? They've been doing those 0% interest rate on balance transfers as long as you pay a 5% fee, or if you get a brand new credit card, like 12 months of 0%, or whatever, 15 months of 0%, or maybe it's a year of like 5% on your interest rate, whatever it is. Credit card companies have been doing bonuses since as long as I've been alive. So just making basically forcing credit card companies to basically do a promo period for 12 months, is it really going to change a whole lot? Like maybe this year, this 12-month period, credit card companies will make less money on the people that they were charging like 25% interest on. But at the end of the day, like, it's just another promo period, right? So I think it's a nothing burger for credit card stocks. And if they take a hit because it ends up going through or whatever, I'm just going to buy whatever I like, in that scenario. So like if American Express ends up going down more, I'm going to be eyeing that. If Robinhood ends up taking a hit because of this for whatever reason, I'm going to be taking a look at that. So it is what it is, man. You can pay attention to politics if you want. I mean, I like this YouTube channel, More Perfect Union, even though I have disagreements, obviously. I still like following them as like a more left-leaning news source, because like, especially on X, I would say a lot of news sources are right-leaning. So I like to have a healthy balance, right? In business news, sometimes it's a little bit right-leaning, sometimes left-leaning. It's a little bit more balanced, which is why I like Bloomberg, CNBC, etc. Because it's more centrist in the middle, right? They strictly care about business. So I like paying attention to business news, but sometimes I'll look at right-leaning news on X, and then on YouTube, left-leaning news, just to have like a balanced view. So I think that's important. But I mean, you guys can check out More Perfect Union. They're not paying me to say this. I wish I was getting paid by More Perfect Union. Look, I wish I was getting paid at all. Like, I make no money from this, so this is just my honest opinions on everything. But yeah, when it comes to the 10% cap, it's a nothing burger. Credit card companies have been doing promo periods for a long time, and this will just be a massive promo period for every credit card company for 12 months. That's it. And it's a good compromise with Democrats. And it's also a good opportunity for people that have been in debt for a long time to pay that down. And if people want to be an opportunist, I don't think it's an opportunity, but if they see it that way, to build up a massive debt load during that 10% period, and they end up getting stuck with the bill once it's over, that was their choice, right? After all, we live in a free country, so. But yep. So let me know what you guys think. That was my, I guess, forecast on earnings, like kind of like what's been going through my mind, and then my opinion on like this 10% cap, and this whole stock trading ban, whatever. But let me know if you guys like this. I really want to live stream. I promise, guys. But like I said, there's only like 5 of you that watch this, so I can't do that right now. And I really want to do live trading, right? Like live streams on earnings and bet like big money. But yeah, we got to get the numbers up, the subs up. So you guys can follow me on X. You guys can sub to me on Instagram. But yeah, I'll catch you in the next one.